Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and today I wanted to talk to you guys a little bit more about the Fed's plan, how nothing that Jerome Powell said in front of Congress this week actually surprised me one bit. And this at least the beginning of the year, that predictions of the market are pretty much out of whack here in regards to what the Fed is going to do, and they've been that way since the beginning of the year a little bit. The Fed has basically never really said that they're on a preset plan to do anything, and they've remained remarkably consistent about that. The market, however, priced in roughly another half a point of interest raises at the beginning of the year, two 25 basis point raises, in January and February. And then they thought that the Fed is going to take a pause and then maybe actually reverse course in the middle of the year. I, for one, never believed that this was going to happen. And if you look back at the live streams I did in the last couple of months, I stated that over and over and over. I thought that the market was mispricing this. And I'll go over why that is. And I wanted to just acknowledge everyone here saying hello today. But I wanted to talk about why that is and what's important about what the Fed is doing and what they can't control, but basically what they're also trying to do to the rest of the world. And to a degree, the rest of the world has the right to be a little bit angry. Okay. And I'm going to talk about that. And it's largely because what the Federal Reserve is doing here in the United States is actually forcing other central banks to take action that they don't necessarily want to take and is going to be detrimental to their economies. Essentially, the United States is trying to export a recession to the rest of the world, even if it doesn't necessarily have one here. And that's a phenomenon over the last 70 or 80 years that's been relatively common, is that if the United States goes into a recession, that recession can be exported to other parts of the world, but the reverse is not true. In fact, it's never been true that a recession that starts somewhere else ends up infecting the United States and we have a recession here. So to a degree, I understand why central banks around the world are not necessarily pleased with what the United States is doing in regards to their currency. So let's take a look at this map right here. And this is a map of inflation over the last year. Now, if you are hearing from any source on television blaming government spending, or in particular COVID spending, for what's going on right now with inflation, that's only the slightest bit true, right? It's only the tiniest bit true. Inflation is a global phenomenon. You can look at this map right here and look all over the world and see that United States had average inflation last year of 7.7%. It was higher during parts of the year. Canada had 6.9%. The UK had 11.1%. France had 6.2%. Germany had 10.4%. Poland 17.9%. Romania 15.3%. Bulgaria 17.6%. Turkey had 88.5%, but that's a very different case. Erdogan actually made a big deal saying that interest rates don't actually control inflation, that low interest rates don't control inflation. And he continued to keep, Turkey's interest rates extremely low. In fact, I still think they're extremely low. But you see that Russia had 12.8 or 12.6% inflation. Kazakhstan had 18.8. The only countries that didn't have inflation last year, like major economies that didn't have a large amount of inflation last year, were China and Japan, for a couple of different reasons. Number one, China's relatively low inflation was due to massive COVID lockdowns and massive decline in consumer spending, coupled with a decline in population. They just aren't replacing their population fast enough, and they're shrinking. Japan is the same way. They did not have mandatory lockdowns, but they had a lot of voluntary lockdowns and social distancing that's still going on today, as well as one of the fastest falling populations on the entire planet. They're just seeing reduced consumer demand overall. I think that the projections going forward for inflation are probably still a little bit overly optimistic, and we're going to talk about what those projections are at the very end of the live stream here when we talk about inflation predictions by the IMF for 2023. But let's talk about what's really going on here, and it's in the background. It's not something that makes news. It's not something that you hear people talk about a lot, but this is perfectly addressable information that's out there. It's perfectly findable information that's out there. It's just not something that people normally look at, and it has to do with bonds. And I just picked the 10-year treasury here in comparison to a couple of other countries' treasuries. And what we're looking at is the beginning of January 2022, when rates were very low. We saw a decent level of separation between the US Treasury on a 10-year basis and say Germany's Treasury on a 10-year basis, from 0.245% to about 1.6% on a 10-year Treasury about a year ago. And that's quite a bit of a spread at this point. That means at that point that we're seeing a lot more strengthening with the US dollar, which doesn't help us out in terms of inflation. It makes our currency strengthen, and it makes our bonds a lot more attractive. The fact that there's that spread between these two developed markets, Germany and the United States. As you can see, as we have raised our interest rates, and the 10-year treasury right now, US Treasury is hitting 3.9% today. Germany's treasury is hitting 2.6%. This is not the degree of spread that the Fed would like to see. They would like to see that spread a lot tighter. So one of the things that happens has been happening for the last 40 years. Every time there's a giant worldwide recession, is kind of the opposite of what you think that should happen. And that is that U.S. Treasury yields are supported by foreign demand for U.S. Treasuries as a safe haven. Even from places like Europe, we see money flow from Europe into the United States because there's generally a difference in demands. Because we are the first people to react in terms of central bank and raising interest rates, and they're going to investors are going to chase higher yield and also safety. They're also going to come to us for safety, even when other countries are yielding, a little bit more, largely because the United States always pays its debts. We may see some disruption of that by June. I don't really think we're going to see the United States fail to pay on its obligations at the end of June, but the fear of that happening is going to increase between now and the end of June 30th, and we're going to see some negative effects on the market. The bottom line that I'm trying to drive here is that the markets are going to be driven by Fed policy until the Fed decides to change directions. And it doesn't make a lot of sense to make these incredible bold moves in order to readjust your portfolio. Basically, don't try to chase the Fed. Don't try to fight the Fed and do something that basically is going to get ruined by Fed movements. Continue to do your dollar cost averaging. When those fear indices peak, at peak fear, that's when I'm going to start increasing the amount of money that I'm allocating to my investment portfolio. I wish I had more to do this in this time. I just don't. But the video that I posted last week talking about the indicators of fear or indicators of doom, those were sort of neutral, edging on greedy. Those indicators have switched to be neutral, edging on fearful right now. They haven't really tipped into fearful territory, but I expect that to be happening probably by the end of next week, and we should see further market declines. But I don't expect outright panic, guys. There's not going to be a giant 20% drop in the market between now and June. By the end of June, we're probably going to have a lot more trailing data on what's going on with inflation, and we're going to talk about that here just in a moment here. The big news in the bond market that is really going to cause a lot of money to be, just also increasing bond yields, increasing CD yields, and increasing yields on emerging market bonds are going to cause this giant sucking sound out of the stock market for a while as portfolios readjust. And we start seeing some people that were a bit more aggressive in the portfolio in the last 10 years or so start to add bonds back into their portfolio. I think that the tightening cycle for the Fed is somewhere between 70 and 90% finished. And we're going to see a few more interest rate increases, probably 4 or 5 more interest rate increases, with the possibility that rates end up a full point higher, maybe a little bit more than where they are currently, which is likely going to throw us into recession, or at least a very mild recession, before the Fed reverses course. Globally, though, I expect the recession to look overseas quite a bit worse than it does here. And that is the Fed's goal. It's not just to reduce demand here in the United States. We are in a global economy. The Fed would much rather reduce demand on a global basis and keep consumer activity high here. And they can do that by messing with bond yields globally. And this is probably something that you guys haven't thought about, because this has not been a part of global strategy for a very long time when it comes to the Fed, but this is not an untested idea. This is something that's been around for a very, very long time. The United States has known since the end of World War II that they can make the rest of the world catch a cold while we remain relatively healthy. And they've done that periodically to help us out when it comes to inflation. So last year, just in most of 2022 was pretty rough for emerging market debt. But last year it did do roughly 30% in that time period up until right now. And we've seen a slight dip in the last couple of days as we're starting to see chances of emerging market debt defaults start to rise a little bit. And we can take a little bit about that. Most of these companies that have lots of emerging market companies rather that have debt, they don't have as much debt as you think. We're looking at countries like Bahrain, Colombia, Egypt, Mexico, Costa Rica, Guatemala. These folks don't have debt like at 100% of GDP like the United States does. It's quite a bit lower, but they still, for a variety of different reasons. Number one, they don't have a lot of they don't have really effective means of collecting taxes in a lot of these countries. And that is one of the reasons why they have a lot of trouble paying back their debt. And that's one of the reasons why if they tried to issue debt that was more than 10% of their GDP in a lot of cases, and you're one of these underdeveloped economies, then you're going to go to the market at rates that are, north of 10% at this point, which you can't afford anyway. So that is a limiting factor when it comes to government debt. For me, actually, Turkey being a member of the EU and having 88% inflation this year due to their central bank policies. That's probably the biggest concern for me, although I think that Pakistan is actually the biggest concern for other people who study emerging markets, and Sri Lanka. Pakistan and Sri Lanka are the biggest ones where we might see defaults. Okay. Tell 666999. Thank you very much for the super sticker. Haven't been getting many of those lately, so I do definitely appreciate that. Serious question. I'm from the UK. Does the Fed want a recession? At this point, I'm going to say that the Fed would love to. So the Fed really doesn't care about a recession in the short term. What they care about is controlling inflation and maximum employment. At this point right now, maximum employment has taken a back seat to controlling inflation. They want to see a few weeks or even a couple of months of unemployment claims at above 300,000, really at above 350,000 or so in the United States. You can say that the United States is officially in recession if we have 2 quarters in a row of declining GDP, along with unemployment over 350,000. So in terms of controlling inflation, the Fed probably wants the rest of the world to have a recession rather than the United States. They probably think that they can thread the needle here and have us go through a very mild recession or no recession at all, while our moves with our central bank end up kicking recession out the door and exporting it overseas, mostly to consumer economies like developed Asia and Western Europe. So I would bet that the rate at which the United States is raising interest rates, the spread that is developing between the bonds in the United States and bonds in Western Europe are going to force European Central Bank to raise interest rates quite a bit more quickly. And they don't want to do that because of increased energy prices. And that is likely to throw Western Europe into recession probably by the end of this year, if it hasn't started already. If we see significant demand decrease worldwide for goods, that would actually be very good for the U.S. economy. Now, guys, so we're on the same page, I'm not saying that this is a great thing to do to our allies or this is a great thing to do to other economies. This is just the way things are happening. Okay. The central bank here in the United States is worried about, inflation here in the United States, but this is a global phenomenon that is caused by supply constraints, snarled supply chains all over the world, where basically when people stopped doing business in one area, they didn't stop doing business altogether. They shifted their businesses to survive to other things, and those supply chains that were in place prior to 2020 still don't exist in the same way that they did prior to 2020. It may be something completely different that comes around. In addition, we have geopolitical challenges and energy challenges at this point. But the reality is that the majority of the reason for inflation has always been supply constraint in one way or another. And a lot of times it's been energy, especially since the late 1970s, it's been energy shocks. So the culprit that everyone always wants to say it is the central bank that causes it by keeping interest rates too low. That's only a part of the equation. Interest rates have been extremely low since about 2000. They've been extremely low, and we didn't really have any out of the ordinary inflation that wasn't easily defeated by raising interest rates until this year. Inflation briefly peaked in 2006 at about 6% for a few quarters before we went into recession, and briefly peaked at about 5% in 2018 before we had a market decline, but one that was really driven by a rise in interest rates. So let me see here. Hello, how's it going? And then Shula's Joe says, do you think 2 quarters of no growth and interest rates will stabilize? I don't actually. And the predictions back in 2021, and I talked about these a couple of times on this channel, is that inflation or unemployment would maybe need to go to 10% for a year in the United States to tame inflation, or 7% for 18 months, or 5% for like 2 years or something like that. And I think that the Fed is probably shooting for a 4 or 5% unemployment for over a 2-year period. And this is what they're trying to prepare us for. They're not on a set path. The idea is to crush inflation, and they really don't care about your asset prices or your portfolio. In the meantime, they're going to crush inflation as quickly as possible so we don't end up in a situation like we were in the 1970s. The situation that we were in the 1970s, by the way, is in no way analogous to what's going on right now. That inflation was driven by, once again, an oil supply shock, but there was a whole different layer involved in there when it came to foreign countries. 72 different foreign countries were pegging their currency to the dollar, and they were actually sucking physical dollars out of the U.S. economy, sticking them in vaults and then pegging their currency to it. That's no longer an issue since most dollars actually exist as electronic entries at this point. So we have a whole different set of issues here. But that's one of the things that I don't want you to think. Like, I think that the Federal Reserve would be very, very happy with continued low growth in the single digits per quarter, less than 3% for sure, and then a slow decline. And I don't think they're going to hit their 2% goal, because 2% is not what the historical average is anyway. The historical average has been between 2 and 3% over the last 30 years. Prior to COVID, it was 2.34%. At least that is the average inflation rate that's being used by all of the different software, financial planning software that I use. Now, companies are estimating that inflation is going to be right around 2.78 to 2.8% over the next 30-year period. So we are looking at, and it doesn't sound like a lot, like 40 basis points there. It is actually quite a bit. And when you compound that over time, we're going to see prices rise fast in the next 30 years over a really long period than we have seen in the last 30-year period. And that's not all going to be all at once. There's going to be sort of punctuated equilibrium where it spikes and then calms down, and spikes and then calms down. But that's like where we are headed into an era where, in not necessarily in the United States, but we're going to see elevated levels of debt. Other things that's insane is that the risk of default or sovereign credit stress is elevated. Is that now we have about 18 countries right now that are since 2022 that are sort of on the list for countries that may possibly default on their debt. And this tends to have a cascading effect across the economy when this happens, right? So the additional effect of sucking money out of the stock market is this. And this is just from bankrate.com. These are advertised CD rates. A 1-month CD at 5%, a 1-month CD at 4.5, 5, 5.25, 4.65, 5. As long as these are around, there's going to be people who don't engage in investing in stocks and choose to put their money in a CD. And I think that on the All In podcast that I was listening to the other day, they were talking about the demands for excess return over the risk-free return is about 3 times if you're going to invest in a company that has like a long life cycle. And that's never been more true than it is today. If I'm going to lock my money up in a CD for a year, as opposed to buying in a stock, it probably means that I don't think that the company I invest in can make up that 15% in a year, because that's what it needs to pay me in order to at least have the possibility to pay me in order to make up for the risk that I'm taking by investing in a stock. And especially when you look at venture capital funds and you look at managed funds and hedge funds, there's going to be this giant pressure to keep those dollars invested. But it's not necessarily going to be this giant pressure to keep those dollars invested in stock. The pressure may be to achieve positive return, no matter what that return is. And not as much of that money is going to go to risky things like basically there's not going to be as many IPOs. And I think the SPAC market in particular is pretty much dead at this point, because there just isn't a lot of that risk capital out there. There isn't any reason to take this enormous amount of risk in return for yield when you can take no risk and get 5%. There are even banks out there right now offering 6% 1-year CDs. 6% 1 year with zero risk, even in a good year, is going to beat out most stock returns. Now, and especially if we actually see declining inflation this year, you could have an inflation-adjusted return in the 2 or 3% range. So CDs are never really priced to where you make money above taxes and inflation. You don't, right? But in the case where we see a declining interest rate environment, you tend to make out a little bit better in that case. But it doesn't matter if the returns or your expected return is far less than what you could make in a stock. There are millions of investors that don't care about that. They want a return of around 5 or 6%, 7%. They're happy with that. They don't care how they get it, if it's in stocks or it's in bonds or if it's in CDs, and they're going to go with the safest route to do that. And you'd be surprised. And let's remember also, a lot of the institutional money that is invested, they don't have a mandate to make beyond 5, 6, 7%. If they are making beyond 5, 6, 7%, their target return, and there's a lot of target return funds that are managed that comprises a huge percentage of the dollars that are actually invested out there. If your target return is 5, 6, or 7%, and you're blowing it away at 11%, it means that you're taking too much risk. And if you're taking too much risk, eventually that risk is going to turn against you, and then you're going to lose deposits because you didn't hit your target return. So if the opportunity for a target return fund is there to use 10-year T-bills, or I'm sorry, 10-year bonds, or even the 3-month T-bill is paying close to 4%, a little bit over 4% at this point. It makes a lot of sense for those money managers to do that. And that's money that's not going to be going into the stock market. Even worse than that, it may be money that's leaving the stock market to go into fixed income. So what we're likely going to see is talk about the 60-40 portfolio being back, talk about bonds with professional money managers all over the industry. They should have been talking about this all along, of course, but fixed income is definitely back, and it's back for a while. And let's talk about that. Or I'm kind of done talking about that for right now. So let's talk about what the Fed is looking at right now when it comes to inflation, and the big piece of inflation that they're looking at right now that needs to come down before we can all say that inflation is really being tamed. And this is not something that is controlled on the international market. This is something that is controlled here. And this is the month-over-month change in the national rent index, 2018 to present. And I've seen this data going back like to 2005. And there is always a seasonal variation where you see at the end of the year declining rents, a little bit of disruption here because of 2020. And even in 2021, we saw declining rents in November and December, and we saw it again in 2022. The encouraging thing is that the growth rates of rents really slowed down. Now we're back into the months where we start to see an increase in, we definitely start to see an increase in rents here. And we did see in January that rents were down. February rents were up, but they're not up as far as they were last year in this time period. So I think that this metric shows that we are definitely on the right track when it comes to inflation, but it's going to take a while. So why is this the most important metric that I'm showing you? You think about inflation mostly when you go to the grocery store. You probably don't think about inflation when you go to the gas pump, because even outside of inflation, gasoline can be extremely volatile. But people don't necessarily think about all of the components of what goes on in inflation. And let's talk about this. These are the weightings of the two different metrics that most people are looking at when they take a look at inflation here. And it's the PCE and the CPI. And let me see here. So we're looking at PCE, which is the personal consumptions expenditure index. This is the Fed's favorite index right here. Shelter makes up 15% of the index. Food and beverages makes up 14%. And medical care makes up 20% of that index. All right. So, and this is why these indexes are viewed so differently. And one is favored by the public and one is favored by the Fed. Medical expenses not only make up a huge portion of personal expenditures, but also corporate expenditures as well. And rent and shelter is a huge part of that as well. We are going to see real significant declines in the CPI until we see the CPI over here, until we see declines in shelter, because it makes up 31% of that index. So this is why we may see wholesale prices decline. We may see fuel prices decline. We may even start to see food prices decline to a degree, but we're not going to see huge movements in CPI until we see the rate of inflation and shelter start to slow down. Thankfully, that has started to slow down. We did see an increase last month that is completely in line with what is normally expected in seasonal adjustments. We see rental rates go up through the year, and then once the school year starts, we start to see those rental rates decline a little bit, and then once again in January they take off again. It was delayed a little bit this year. We saw a little bit of an increase last month, but it wasn't as big as the increase for a year prior. This is a really, really good sign. But because rent is such a huge part of the CPI, it's going to be, I would say that we'll probably end up seeing a measure of deflation in our real lives before we see the CPI start to decline meaningfully, and before we see, between these two indices, before we see the Federal Reserve really start to take action on those, because they're looking at trailing data, right? They're looking at trailing data, and this trailing data is so dependent on this one large factor, and this one large factor has the seasonal variations right now that we're heading into an increase. So I think it's going to be quite some time on a macro basis before the Federal Reserve is going to say, all right, man, we're not just on the right path. We've kicked inflation's butt, and they said we've started this disinflationary process, but this disinflationary process is going to take quite some time. And until that is done, I don't think the market's really going to go anywhere. I think that there's a very good chance that we hit 3,800 by June 30th. A very good chance. I think there's almost no chance that the market goes over 4,200 in that same time period. So I think this is and I was reading one Barron's article earlier today, basically trying to make a case for this being the beginning of the next bull run. I don't think it's the beginning of the next bull run. I think we hit the bottom of the market sometime in October of last year. I think we're not going to retest that bottom, but we're probably going to retest 3,800 for the S&P 500. And after June 30th, we see some measure of stability and some measure of clarity when it comes to what the Federal Reserve is going to say. Because here's what we can look forward to going forward into the summer. China is opening back up. Demand in China is opening back up. That means they're going to be taking a larger slice of the pie in terms of consumerism, but really they're going to take a larger slice of the pie when it comes to fuel consumption. So we are going to see prices rise with oil through the end of summer before they start to decline again in September or October. Really, this is a function of increasing demand from China and seasonal demand. It's going to catch traders by surprise. And I wouldn't be surprised right now if we start to see futures start to get, the market in futures is going to get hotter and hotter and harder. I don't know where prices are going to end up, but remember, once a run starts in oil futures market, sometimes it's kind of uncontrollable till it all crashes. Look at 2007 for an example of that, where oil hit roughly $150 a barrel. And the only thing that saved us from oil staying there was the beginning of the fracking revolution and an addition of about 7 million barrels a day to U.S. production between 2005 and 2020, or 2023, actually. And almost all of that came from fracking, by the way. So without fracking, and I know people hate fracking, especially environmentalists, they absolutely hate fracking, but without it, you'd be looking at oil at $150 a barrel. And fracking has added about 1% annually to our GDP growth, which is huge. I think we've only averaged like 3.5% GDP growth since then. But since 2009 or so, it's averaged about 1% annually to our GDP growth. It's contributed that much to our economy. So, and the fracking revolution in oil may be peaking. It's still going to be king in natural gas production for quite some time. So let me see here. Slightly off topic. I'm in the S&P 500 ETF, and I bought individual stocks, SoFi and Tesla. Can you recommend a couple of good books to manage? Actually, if you look back in, let me actually grab some of those links right now, and I'll put them after we're done. But I have a couple of them. A random walk down Wall Street. I usually put these links to these in a description sometimes, but a random walk down Wall Street, the Little Book of Common Sense Investing, Security Analysis, 6th edition. And those are the 3 best books you can buy that are easily digestible, and they're useful to beginners, and they're useful to professionals as well. And there are a lot of people that work as financial advisors that don't have a freaking clue about how to do security analysis and come up with come up with a fair market value for that stock, come up with like a book value for that stock, come up with a dividend growth model or anything like that. They may have done the calculations once or twice when they were going through to get their Series 7 exam, but the reality is they don't know anything. They never read past their study guide. Those 3 books will give you a very, very good foundation. And after this live stream is done, I'm going to post that to the description of this live stream. So, Florin, just want to say, yes, everything is good on my end. It's nice to hear from you guys too. Okay. So look, inflation forecasts for 2023 look quite a bit better. This is and you can take this with a grain of salt. We don't know if this is actually going to happen. But the United States, by the IMF, the United States is projected to have about 3.5% inflation. The UK is expected to have about 9% inflation. Iceland about 6.5, or Ireland about 6.5. Germany about 7%. France about 4.6%. Spain about 4.9%. And large part of this has to do with the giant spread right now between, U.S. bonds and bonds in Europe. I actually expect Europe to have a little bit less inflation than this year, because I think that their central bank is going to start kicking it up a notch in terms of not only security sales to raise money, but they're actually going to kick that up in terms of rates by tightening interest rates. And you're going to see that Venezuela is still looking at 195%. Argentina is at 76.1%. Zimbabwe, these are always the outliers. These are always the outliers because they have really terrible monetary policy, but they're estimating that China's going to have 2.2%. I think that that's probably going to be a bit higher. I think people are going to estimate the amount of money that people are going to go out and spend once they are released back into the wild. And they're estimating that Japan would have 1.4% inflation. I think that's in line with expectations. They have a population that is absolutely just crashing. And Japan's a problem. It is a first world economy that within our lifetimes is likely to drop down to literally their economy may be half the size it is today by 2021. It may be half the size. China as well, just based on population decline. Japan refuses to do the one thing they could do to reverse that process, and that is to encourage inflation. Let me see here. And when is the U.S. debt ceiling to be discussed? The U.S. debt ceiling is only discussed when it's convenient to make political hay out of that discussion. And it will be convenient to make political hay out of that discussion around June 30th. And there's going to be a lot of finger pointing, and there's going to be a lot of debate, and there's going to be a lot of people trying to get TV time. And at the end, they're going to come up with a compromise where they symbolically cut spending in one area. They don't touch spending in 2 areas where it needs to be touched, and that is Medicare and that is military spending. They're going to cut symbolically a couple $100 billion out of our budget somewhere else. I bet it's going to be less than $100 billion. Less than $100 billion out of a $1.3 trillion budget or something like that, which is significant. Don't get me wrong, and a decrease in government spending would actually contribute to this disinflationary process. And I am hoping for this, by the way. One of the biggest steps towards decreasing our long-term budget deficit was taken last week by Eli Lilly. And let me tell you why that is. Lilly decided to reduce monthly expenses for insulin down to $35 out of pocket per month for clients. Why is this a big deal? And why do I say it's going to reduce the deficit? Because 1/3 of Medicare spending is done because of kidney issues. A lot of that has to do with the something like, I think there's something like 28 to 30 million people in the United States that have diabetes. The number actually may be larger than that. I'm not sure. But it's the people that have type 1 diabetes that end up on dialysis most of the time. But 1/3 of the budget has to do with kidney issues. Just making insulin cheap enough for people to afford it is going to have long-term money-saving consequences down the road. And a large percentage of those kidney issues are caused by people who didn't go to the doctor when they had the first signs of diabetes because they didn't know what they were, or they were too afraid of incurring the expense of going to the doctor. A lot of those are from people who ration their insulin. NPR did a great story on this where they interviewed a bunch of people who had been prescribed insulin, who were knowingly and willfully taking only half of what they were prescribed in order to, because they just couldn't afford it. They may have had insurance, sometimes they didn't have insurance, but it was anywhere from $300 to a couple $1,000s a month, depending on what they needed in terms of insulin. Where I live here, right next to the border, people routinely cross the border to buy insulin in Mexico because it's dirt cheap there, and they bring it back here. But the reality is, even using half of your dosage means that you're probably going to have vision problems, and you're going to end up on Medicaid or Medicare, and you won't be able to work. It means you're going to have kidney issues later on in life, and that cost is going to be shared by people in the rest of the United States through Medicaid or Medicare and Medicaid. And it just makes a lot more sense for us to set, not necessarily set price controls, but to encourage price controls through various means. I think California was planning to build their own insulin plant here, production facilities, and provide it at cost to people, largely because they see it as an investment in lowering overall medical expenses. But honestly, that'll probably have a bigger effect on the budget future-wise than anything Congress does by the end of June. They are generally useless, but even more so in the last 4 or 5 years or so. But yeah, hold on a second here. And let's get with any questions here when we talk about debt ceiling. The debt ceiling isn't necessarily real, by the way. It's not something that people aren't going to raise. It's a way to avoid the very difficult discussion of saying, hey, we have to cut spending somewhere, and we do have to cut spending somewhere. And it basically, we need to take growth out of the hands of government spending at this point and put it back into the private sector. I would like, if we are going to spend as much as we're spending, I'd rather see it being spent on infrastructure projects than on the way we're doing it right now. I would like to see more education spending, more infrastructure projects, more investment in developing the economy of the future. Oh, let's talk about AI. I've gotten a lot of questions about AI recently and about what to invest in. And look, there's a definite fear of missing out right now when it comes to AI stocks. There's an AI stock there where of a company that I follow and that I like, and I'm not touching with a 10-foot pole right now because I understand their business. I understand the type of government contracting they do, and I understand what their expected growth rate is like. I'm talking about Big Bear AI at this point. But they spiked up to like $5 a share recently. And I told people in my Patreon group, hey, man, you may want to sell out now. This isn't going to last. This is a temporary thing, kind of like basically like meme stocks were a couple of years ago. But this is one that's likely to last a little bit longer. And it's going to result in the same sort of disappointment that the internet did. And you're saying, what are you talking about, Jason? No one's disappointed with the internet, right? Well, I mean, I'm certain people are disappointed with the internet. Let's talk about search as as an example of what went on right now. Basically, back around the year 1998, 1999 or so, investors are basically just throwing money at the wall and hoping that something stuck. When it came to search, as far as search driving the profits of a company, basically nothing stuck except Google. Bing is, I'm sure lots of people use Bing, especially now that maybe changing a little bit with ChatGPT. but Bing is not the primary revenue driver for Microsoft, right? They have other ways of making it, software sales and cloud services that drive sales for Microsoft. But Google made their billions on the back of search engine and advertising relevance. Every other search company out there, Yahoo, basically a failure. Even though I love Yahoo Finance, basically Yahoo's a failure. Was it Lycos? It's a failure. Infoseek, it's a failure. Ask Jeeves, it's a failure. Hasta La Vista, it's a failure. All of these search engines were failures, and there were tens of billions of dollars, if not hundreds of billions of dollars, shoved at them in that frenzy, thinking that the internet is this huge change of platform. And that's going to be good. And it was a giant change of platform. There was just only one winner and everyone else failed. So, guys, this happens with every giant change of platform, right? So, what is the wiser bet here when it comes to betting on the AI revolution? If there is a huge change of platform, if like we went from the internet or PCs being a change of platform, then we went to internet being a change of platform, and we went to mobile devices being a change of platform, cloud being a change of platform that you don't necessarily see if you're just a user, but it definitely is. But now we have AI being this change of platform. My present, what I'm going to present to you is the idea that don't try to bet on an individual AI company. There's something like 200, or no, I think I heard that there's something like 500 or 600 different chat-based AI companies right now that are seeking funding out there. Something like already $11 billion in investor dollars have been allocated. Most of that is going to evaporate, folks. How do you make money off of this? Guys, I think you go to the source and make money off of this. You make money off of this like Levi Strauss did, which is to, instead of trying to make all your money in the gold rush by mining for gold and going bust, why don't you just sell them Levi's? Because no one's making them pants. And what I'm really talking about here is semiconductors. Who are the leaders in semiconductors right now? And the other point you should make about Google too, and when it came to that sort of internet search revolution, or everyone going to getting their information from the internet, is that Google was nowhere near the first mover in the market. They were not first at all. And I think they only went public in 2005. And from 2005 to like 2008, they were pretty much the only growth story out there. Everything else was a value story, right? The idea here with AI is that some of the largest players like Intel are in big trouble because they are not set up for the most complex type of chip making here in the United States. And we're going through a rapid shift here, bringing our high-tech chip manufacturing back to the United States. We're really highly encouraging TSMC to build this giant factory in Arizona. Part of it is risk mitigation on their part. They don't know if they're eventually going to get invaded by Taiwan. I don't think that China's ever actually going to invade Taiwan. It's very costly. I think it's also very useful for them to perennially play the victim to the United States when it comes to us supporting Taiwan. But I think that Taiwan Semiconductor Manufacturing is going to distribute their manufacturing of chips worldwide at this point, simply to avoid industrial espionage and things like that from agents of mainland China. Which they just view this very differently than we do too, right? They engage in industrial espionage all over the world. We do too. Don't get me wrong. They have a different view on it though, as far as its legitimacy. We know that it's illegitimate. They think that if it's out there and they grab it, it's theirs. Okay. So the issue with this is that who's the winner now is not necessarily going to be the winner in the future. But there are a couple of companies that have a huge head start, and TSMC is one of those. And of course, NVIDIA is the other. And NVIDIA, if you can stomach it, I think is an incredible long-term bet for a variety of different reasons. They are hitting it out of the park in a number of different applications, just like SoFi is no longer all about student loans, even though they're doing that lawsuit that I'm not in favor of. I'm not in favor of the lawsuit. I just want someone else to do the lawsuit and get all the negative press, right? That's all. I want student loan payments to resume. I just want it to be done, and all these lawsuits be executed by someone else. But where was I going with this? Anyway, I think that's kind of what's happening with NVIDIA right now. Just like SoFi diversified away from student loans, NVIDIA is diversifying very, very rapidly away from being just a graphics company. They've been first and foremost in terms of graphic cards for quite some time. But that technology has led them to other applications that they weren't originally intending to be involved with. And AI is one of those, although they did make a pretty deliberate switch to that back in 2018 or so. So, yeah. And let me see here. This is what I don't get in the US. In the UK, we have NHS. Yes, it's paid for by taxes, but you don't get a bill for treatment if you have medical help. I can get for no charge. So Americans just don't understand or refuse to understand is that not only is your medical care, even though as bad as NHS is, it's still better than medical care you can get in the United States. And most people listening to this have never actually had a serious problem. There is no amount of money that you have that is safe. I've known people that had $10 million in the bank. They had insurance, and then they had a child who needed multiple organ transplants and needed immune treatment after that. And $10 million was gone over the course of 10 years because it wasn't covered by insurance. And these were people that were wealthy. I've known people that retired with $5-6 million in the bank, and just the normal maladies of aging that you were going to get that were perfectly curable. A lot of the treatments were not covered under Medicare. Now, they retired a little bit before Medicare, so they still had their company insurance, but a lot of it wasn't covered, and they end up having to go back to work after they had drained all of their savings. So what people don't realize is not only is medical care better in Canada, in France, in Germany, in Japan, in Indonesia, in Taiwan, it's cheaper. And when I say cheaper, it's anywhere from half to a third of the cost overall in terms of what they're paying in GDP. It's something like a third of our GDP annually goes to medical expenses here. And it's because for a variety of different reasons. This is the massive systematic fix that needs to be made. The big thing right now going on with the drug industry, and I have a Facebook friend of mine who we're not really friends, but I've been Facebook friends with him for a long time. He's just under the impression that the United States subsidizes drug production and drug purchases for the rest of the world. And they do that by the United States charging more for clients domestically here. And he's dead wrong on that. Most other countries negotiate drug prices as a country and therefore have purchasing power. When you're looking at individual service providers in a state in the United States that cannot collectively bargain because it's forbidden by law here, they don't have any purchasing power. And therefore, they're kind of at the mercy of the different drug producers here. There's a reason why your individual service provider in the state of Louisiana doesn't have the same purchasing power that an entire system like Japan does, because they're negotiating on behalf of of an entire country of 130 million people and providing medicine for them. It's basically, they just have more purchasing power. They have more power to negotiate. And individual service providers here in the United States, they don't even negotiate on a state by state basis. They negotiate on a provider by provider basis or group of provider basis. So that is one of the reasons why our medical system is so messed up, and it's not going to get any better until we decide to do something about it. And I think that collective bargaining is one of those things that should be passed by Congress. And that's something that I think that all parties should get behind, but they won't. There's nothing wrong with collective bargaining by at least states in order to buy pharmaceuticals in order to buy some pharmaceuticals. Anyway, so Sheila's Joe says, do you have a view on Kohu Inc? I do not. I don't know who they are. Let's see if I can, my connection actually, my connection cooperates with me today. So we go. Oh man, I didn't look at the market in the last hour or so. That doesn't look good. Dow Jones down 534. The S&P has slipped to 4,000. So the March to 3,800 is begun. Actually, I don't know that it's true or not. Right now, what we're seeing is not panic. What we're seeing is repricing. People are repricing what they believe what people believe that the Fed was going in the future was to lower interest rates 2 times this year, and then we would see a pause. stock, to be honest with you. So I can't really have a comment on it. Um, yeah, earnings aren't really telling me that much. Quarterly earnings aren't telling me that much. Earnings beats right now shouldn't be telling you that much right now either. And that's largely because of the giant manipulation that's been going on in earnings beats since the beginning of last year. And that's that we've seen companies revise downward over and over their forward guidance and then ending up beating their quarterly guidance over and over. And I think that you shouldn't pay that much attention to earnings beats going back over the last year. And that includes for all of my favorite stuff. And in particular, right? But avoid throwing pasta at the wall and seeing what sticks when it comes to the AI industry or even the chip industry at this point. I would be looking at companies like the Dutch company. I just can't think of their name right now. I'd be looking at there's also a Swiss company, which STIM, I think, that I can't remember. And I would be looking at them right now. I'll be looking at Taiwan Semiconductor Manufacturing, and I'll be looking at NVIDIA right now. And even Tesla may end up becoming, not anytime soon, but even Tesla may end up becoming themselves a producer of chips. ML is the company that I was looking at right now. They are making moves to diversify their manufacturing away from China as well. They've already made giant moves, but they're making even more moves to do that. And they're relocating. And then the company, I don't want to say English because I don't know if they're actually Welsh or Scottish or Cornwallish, whatever. I don't know all the countries in the United Kingdom. Sorry, guys. I probably do. I just can't think of them on the spot. But and I want to be sensitive to your culture there. But yeah, so those are the companies I'd be looking at when it comes to an AI revolution. NVIDIA right now seems to have the pole position though in the race. And I'm saying that though, that there's going to be so much demand for AI chips going forward here that they're not going to be able to produce all they need to meet that demand. So someone else is going to step in and fill the shoes. I don't know who that's going to be. Is it going to be ASML? Is it going to be TSMC? Is it going to be that Swiss company that I can't think of right now? But somebody's going to step in and fill that gap. And then there's going to be a company or two that emerges dominant in that space. I'm going to say, though, that I don't believe it's going to be Intel. I think that we may be seeing Intel fall behind. They have basically stared changes in the semiconductor market and in the face for a long time, and they really haven't done much to invest in their future. AMD is another. I think that Intel and AMD in the next decade or so, maybe only one of those companies survives. Maybe one acquires the other. I don't know. But I think that's likely to happen in the future. We're going to see a huge shakeout of the semiconductor industry fueled by this platform shift. And we saw a huge shakeout done back when with the changeover to mobile devices. We're going to see another huge shakeout when it comes to basically to the AI revolution here. And when you look at NVIDIA being a dedicated graphics processor, they were a dedicated graphic unit processor from like 1993 to roughly 2016. It was literally almost that. That was all like 99.9% of their business before they were forced to diversify. They didn't have to diversify because every other gaming graphics processor that was a dedicated processor went out of business or was acquired. And so they didn't really have to innovate until his name's Jensen Hu. Then they brought in the new CEO, and he really sort of reorganized the company and gave it a new direction. And he brought in people that were able to give it a new direction. That's going to happen at some point. NVIDIA is looking expensive at the moment. Hope to buy more if it drops. You know what? That's actually a very wise thing to say. And I would actually sell puts out there. I wouldn't wait on the price dropping to where I think it's going to drop. This is so volatile that it blows through most option strategies. I have not been able to make money selling options on NVIDIA, and I've ended up having to pay taxes on gains a couple of times when I really didn't want to. But if I wanted to buy more NVIDIA now, I would probably sell puts at 175 or 180 as soon as we are going to see, and we're just going to see price volatility in that stock. It's way more volatile than the rest of the market. And if you're going to wait around to buy the stock at 175 or whatever your target market is, why don't you get paid to wait? If you bought a put at 175 out as far as September or October, if the price dips below then at that point, you anytime between now and then you can exercise. And if it doesn't, you get paid. So I just sold some puts at like 175 or something on Tesla, going out quite a bit. They're in the money now. But essentially, I'm going to be forced to buy it at 175. I'm happy to buy Tesla at 175. But if the puts had never exercised and expired, my return on that was like 11% for waiting that long. As it is now, I'm going to own Tesla at 175. If those people, whoever owns the put, decides to exercise it, I'm happy to own it at 175 and happy to turn around and sell call options if I do have to own it at that price. But what I'm saying is that I'm willing to bet a little bit on bearishness at this point to perhaps pick up some shares at a reduced price. And not only that, to get paid while I wait to do that. All right, guys, we are at close to an hour today. And I wanted to close us down about an hour. Got about 5 more minutes or so. If you guys want to push through some questions, I'm going to be on for a few more minutes. Let's see if I missed anything here. Let me see here. Doesn't look like I did today. But yeah, any questions you have about individual stocks, push those forward. Any questions about inflation or Fed strategy, push those forward. Bottom line with inflation and Fed strategy is that we're going to see more interest rate increases. We may even see, I know that the Fed said that they're not, committed to a 1/4 point interest rate increase. I know that a couple people in the Fed have said it might be 0.5%. I'm saying we're going to see 3 to 5 more 1/4 point raises sequentially until we see real evidence that inflation is declining. The problem is by the time the Fed sees that based on trailing data, that inflation is really declining, this disinflationary process has started, it's already actually going to be well underway. So if I sell a long-term buy and hold, it's no longer a long-term buy and hold. That term is a lot shorter. SoFi, even if they just based on cost savings alone, they're saving about 190 basis points on funding loans at this point. Even if they hit the bottom end of their guidance at 25%, just based on savings, if they begin to offer CDs, we're seeing a giant increase, and the increase in their deposit base of they went from basically $1 billion to almost $8 billion was entirely driven by direct deposit, right? Or almost entirely driven by direct deposit and driven by their savings rate, which is at 3.75%. I wouldn't be surprised if we see that savings rate, which is completely liquid. You don't have to lock it up or anything. That savings rate being close to 4%, 4.25% by the end of the year. You're going to see an expanding deposit base, a cheap supply of money going in. They're probably going to be able to reduce their spreads on the loans that they are offering and still profit. I'm estimating that they're going to have an additional $30 million of profit or so just driven by cost savings, not just from the decreased cost to fund loans, but from a variety of different ways they're the saving cost. Here's what I wasn't anticipating, though, and that's the legal expenses associated with the lawsuit that they just filed. I don't know how serious they are about that, or if it is. Well, I don't know how serious this move is and how much money they're actually going to dedicate to it, but legal work is expensive. But I would estimate that their quarterly cost savings is about $30 million per quarter. With the slightest increase in business, they will be profitable not by Q4 of 2023. They will be profitable by the end of third quarter. And that is my prediction, is that they will be profitable. I think that we're probably going to have a fairly substantial earnings surprise when it comes to SoFi when they report first quarter earnings. And I think that their loss the consensus is that it's going to be 5 cents. I think that it's going to be 1 or 2 cents per share is what their loss is going to be. And a lot of that has to do with about $30 million in savings and basically an increase in business on the order of about 25%. And I could be really undershooting the increase in business by about 20%. I could be vastly undershooting that. So So what would make a good earnings call for Moneyline for anything? I don't actually think that anything can make it a good earnings call. So they will not be profitable on the 14th. They will likely show there's not a lot of information out there. I was trying to put together a video and then I realized when I'm trying to put it together, there really isn't enough information out there for me to put together a video that is really fact-based. But I will give you my opinion here. There's nothing available out there on the state of their business other than what is they made available through their official publications, like their filings and of course their presentations and all that, and their balance sheets and their income statements. So growth slowed between quarter two and quarter four. Times they tend to have pretty good growth quarter. Moneyline tends to have good growth between first and second quarter, and then slowing growth in third and fourth quarter. I don't know why, but that seems to have been the case in the last couple of quarters. But it's actually even though they had record revenues, they had anemic growth compared to the prior quarter. Some of that is headwinds, right? So they don't necessarily have all the funding issues that a bank like SoFi or that a company like SoFi would have had prior to having their own bank, because they really just offer their loan products on a third-party basis. Really what they do is they match up products to match up willing sellers to willing buyers, but they package together in an app, and they really focus on that financial education piece. And for young, like young, like Gen Z people, it's actually a great app for them. SoFi is really geared towards people with a little bit more financial experience and a little bit more money. Moneyline is really geared for people who, Cash App is not the best place for you to have your money. Venmo is not the best place for you to have your money. A lot of these other apps are not the best place for you to have your money to get the whole package that includes the investor education that you're going to need in order to get off on the right foot if you're in your early 20s. Moneyline is really doing that. And there's a couple of different ways of attacking the market, and they're attacking the market by saying, hey, we know you're going to be worth money one day. Let's educate you on how to get there. And they offer you sort of the products and services and advice that you need to get there, right? So, but Moneyline switched gears last year away from growth at all costs, and they went to, all right, let's improve our earnings. And they have seen sequential growth in their EBITDA over time. And I think, just from memory, that they were at negative 14 cents per share last quarter. They could cut that in half, and I still don't think the market's going to react that positively. I think the market doesn't react positively to Moneyline because people don't understand their business. They haven't done a very good job of staying in the public eye or publicizing themselves. I think that they don't have real positive move in their stock until they actually show profits. I'm not sure they can do that before the end of the year. They have an additional issue right now when it comes to raising money. Their outstanding debt on their books is roughly equal to the entire market cap of their stock. They're going to have trouble borrowing money at rates that look anything near decent at this point. So they've got to make money based on organically increasing their business, right? They're not going to have the money to go out and make acquisitions. That's one of the ways to grow your business for new capabilities. They've got to organically grow their business. And luckily for them, though, their customer acquisition costs are like $6 or $8 per person, whereas SoFi's is close to like $300 a person right now. Their customer acquisition cost is $6 or $8 a person, and their product revenue per customer is somewhere around $7 per annually, right? So they have very good metrics in that department, but they're forced to grow on an organic basis right now. I don't think that unless they hit profitability out of the blue, I do not think that the market likes, or I don't think they're too excited about what happens on the 14th. That's what I'm saying. I still hold this. I mean, I bought a lot of shares for next to nothing. Like I had like 18,000 shares of the stock, but I paid like for the first couple thousand shares, I paid like $2.50 a share. But like for the last 10,000 shares or so, I paid under 75 cents a share. So this is a long-term speculative bet for me. And it wouldn't hurt if I lost it all. SoFi, on the other hand, not only is my cost a little bit higher on that, I've got a lot more riding on that in terms of dollar amount. I've got a lot more. I probably have more emotional. I know I don't ever show emotions on the live stream, but I probably have more emotional involvement in it because I feel like I'm right. But I have to take a look back at the numbers all the time to make sure that I am. I also have to make sure that I'm not just looking for confirmation bias here. But I do think that that is SoFi is a great long-term bet, but I don't think it's as long as you think. I think that by the end of the year, it's going to be worth $10 to $14 a share. I think by the end of the year after that, it's going to be worth $20 a share. I think by 2026 or so, 2025, 2026, it's going to be earning 50 to 60 cents a share. And it'll be worth, fair market value will be somewhere around $17 to $20 a share at that point. That's what fair market value is. But I think that there'll be a premium placed on it because of growth, because we're going to see growth in the technology sector as well. And it'll probably be worth quite a bit more than that. But that's just my opinion. Anyway, folks, I do have to go now. I do have other work to do today. But as always, I enjoy this. Thank you very much for your questions, and I will see you next time.